Let's settle this. BlackRock just flipped from long bonds to short-dated treasuries. With the Fed's flip-flops, what should you do? Bleed slowly with safe yields? Or chase wild upside elsewhere? Watch till the end to see which bet could protect your portfolio. Could it be the safer route or the riskier one? Your financial future might depend on it.
Gary, we're going to talk about BlackRock now. They've shortened the duration on its Treasury portfolio. We've had Jerome Powell, and as we've documented multiple times on this show, Jerome Powell claiming he doesn't have confidence in Fed projections. Obviously, extremely hard to blame anyone with not having confidence in Jerome Powell's projections, as we've highlighted, as I mentioned. Thing number two, Gary, BlackRock bets on the short term.
Yeah, that one made me laugh, Rob. So what's happening with BlackRock is they're shortening the duration on their Treasury portfolio. Just a fancy way of saying instead of buying more 10-year bonds or 20-year bonds, they're buying more 2-year bonds, right? And that's it. They're just going shorter on what they're purchasing. Now, the thing that I think is really interesting on that is, and Cashin Crow, DKI star intern from the University of Tennessee, did a great graph on this for the written version. And what he showed was that a year ago, the yield curve was inverted. Okay, just a fancy way of saying that you got paid more for short-term bonds, a higher interest rate, than you were getting paid for long-term bonds. Now, the yield curve wasn't entirely inverted, but most of it was. Now, this year, we actually have a mostly normal and much flatter yield curve, which, again, just a fancy way of saying that if you want to go out to 10 years, you'll get paid more than you would if you were buying 2-year bonds. And so what's really interesting about this is BlackRock is saying, last year, they were buying more long-term bonds when the yield there was lower and fewer short-term bonds relative to where they are this year when the yield was higher. Now that that's reversed, they're actually buying more of the 2 years and fewer of the 10 years. So the yield curve has gone more normal, but they're still shortening their duration. Now, obviously, part of it is exactly what you just said. There's a lot of uncertainty. And if you're buying bonds going out, that won't be paid for 10 years, then you're taking a lot of duration risk. You don't know what's going to happen over the next 10 years, and you're trying to project over a longer, more uncertain time period. And as you pointed out in his last press conference, even Fed Chair Jerome Powell said, we don't have a lot of confidence in our projections. And, in fairness, let's give the chairman credit for saying the truth in public. I don't have confidence in the Fed's projections either. So good for him for acknowledging it, but that's what's going on with BlackRock.
Gary, in terms of BlackRock and their conclusion, I mean, do you agree? Do you disagree with their conclusion? And then in regards to you, I mean, what would you do in this particular situation?
So 2 sets of questions there, Rob. Let's take those in order. First, I can't believe I'm going to say this. I typically disagree with BlackRock. I've been not a fan of them for many, many years. I think they're making the right call on this one. Again, one of the reasons the yield on the 10 years come down is investors are pricing in an expected reduction in the Fed funds rate. When that happens, and it will happen at some point, I don't know that you're necessarily going to get lower long-term rates. I think the market will price in higher long-term inflation. In addition to that, one of the things that we were saying, and Rob, you remember this last summer and all last year, is there are lots of reasons to go vote in last November's election, but lower government spending isn't one of them. We said that no matter who won the election, whether it was Team Red or Team Blue or some combination, that Congress is going to spend more and more and more. That is exactly where we are right now. What happens with that is the only way we can afford to spend more is to take on more debt. That involves an increase in the money supply, and that leads to inflation. So when that happens, we're going to be looking at higher long-term yields, plus the economic uncertainty. That's what's pushing investors into lower duration bonds. I actually think BlackRock is thinking about this the right way. If I were them, I'd be doing the same thing, except I wouldn't be buying government bonds. So, you were asking the question, what is DKI like? And here's the thing, people think about government bonds as being safe. And I think that's a misnomer. It's safe to the extent that the government will pay you back, right? If you if you lend the government $1,000 for 2 years, in 2 years, they'll pay you back. And there's no risk that the government won't be able to print the currency and hand you, $1,000 of fiat currency. I don't think government bonds are safe simply because who knows what the purchasing power of that is going to be. They'll give you your $1,000 back, but what will you be able to buy with it? And inflation runs, as we've talked about many times on the show, well above what the CPI is, what people think inflation is. Anybody who's gone to the grocery store knows we're not at 2% inflation. Anybody who's tried to buy, a car or a house in the last few years, right? We're not at 2% inflation. That's kind of ridiculous. So, basically what I prefer are uncorrelated assets like gold and Bitcoin versus treasuries. Now, some people will say, well, wait a minute, I like the predictable return of government bonds. And if you are a senior on fixed income, yeah, I get it, right? Gold and Bitcoin, that's a very uncertain return. You could lose money in them. If you need that money to live on, of course, you need something where you have predictable cash flows like treasuries. But if you have a little more time and a little more risk tolerance, my response is I would much rather own gold and Bitcoin, much more Bitcoin than gold. And so the question that we're asking is, would you prefer to lose money slowly in government bonds or make money inconsistently in things like Bitcoin and gold? And that's where I am. I'd rather make money inconsistently.
Yeah, I think it's been pretty obvious where we sit on this topic. Inflation too, you just in general conversations, right? It's just funny the way you think about things. $1,000, $10,000, even $100,000 in certain conversations, and like just the buying power. Like you can feel the difference in every single conversation you have. And if you're a loyal follower of DKI or a new follower, you know that inflation is going to continue to run rampant, or at least that's our position. And we've set up portfolio positions for DKI specifically for that, which leads me to, we'd love if you could head over to our website, deepknowledgeinvesting.com. Grab a free subscription. That'll get you signed up for our newsletter. You could also consider a premium subscription and access to all gated content material, webinars, current recommendations, buys, sells that are being made in the market by Gary.